Hello, and welcome to this webcast on IFRS 16. I'm Katrina Buchanan, and I'm joined today by my colleague Catherine Dunkersley. This is the second in a series of webcasts we'll be doing over the next couple of months following the recent publication of the new Leases standard. Today we'll be talking about the transition requirements on IFRS 16. Just to note before we start that, as always, the views presented in this webcast are those of myself and Catherine and don't necessarily represent the views of the board or the IFRS Foundation. So we briefly talked about this topic during the introductory webcast back in January. We mentioned then that the IASB has really taken a very pragmatic approach to transition and has included a number of transition reliefs for lessees. Now, most of these are optional, and that means there are a number of decisions that need to be made when a lessee is planning its transition to the new Leases standard. So the way we'll run this webcast is to work through the transition steps that a lessee will need to think about in order, and at each stage highlight the reliefs available and the decisions that need to be made. So as summarised in the introductory webcast, IFRS 16 lessee accounting is very similar to IAS 17 finance lease accounting. In practical terms, therefore, existing finance leases don't need to be transitioned to IFRS 16 because a lessee can just keep doing what they're doing today. And the IFRS 16 transition requirements make this point explicitly. So this webcast is therefore focused on how a lessee gets from today's operating leases to IFRS 16 accounting. Just to note briefly the things we won't be talking about during this webcast. First, we won't be going into detail on sale and leaseback transactions or on subleases. Appendix C of IFRS 16 does contain some particular transition requirements in respect of these items, but we will be concentrating today on the transition of today's operating leases for lessees, because that is the process that will be by far the biggest element of transitioning to IFRS 16. Similarly, we won't be talking at all about lessors. That's because lessor accounting in IFRS 16 is substantially unchanged as compared to IAS 17. So we'll start today with a high-level overview of what all of the practical transition steps are for a lessee. And after this, we'll go into detail on each one. So Catherine, do you want to summarise?
Yes, of course. So first, a lessee needs to identify the population of contracts to be transitioned to IFRS 16. Second, it needs to decide which of the two transition methods it will apply. One of these methods is a full retrospective approach in accordance with the normal transition requirements in IAS 8. The alternative is the cumulative catch-up approach, under which a lessee does not restate its comparative information and can also choose to apply a number of other transition reliefs on initial adoption of the new standard. The first of those additional reliefs is effectively step 3. If a lessee decides to use the cumulative catch-up approach, it could reduce the population of contracts for transition by choosing to exempt any leases ending within 12 months. We'll talk about the potential costs and benefits of taking this option. Finally, having then pinned down the population, a lessee will need to measure firstly the lease liability and then the right of use asset in accordance with IFRS 16. Again, we'll talk about the choices that a lessee has here and the transition reliefs that it may want to make use of.
So starting at the beginning then, a lessee will need to identify the contracts to which it needs to apply IFRS 16. Now, many might assume then that the natural starting point of this transition population is today's operating leases?
Yes, and that certainly wouldn't be a bad place to start. In fact, the first transition relief permitted in IFRS 16 enables a lessee to use exactly that population without any further consideration. This relief, if taken, gives the lessee the option to retain the existing assessment of whether or not a contract contains a lease for all existing contracts. That means that an entity can assume on transition that existing leases continue to be leases and that existing services continue to be services, and transition its contracts to IFRS 16 on that basis. The definition of a lease requirements in IFRS 16 would then be applied only to new contracts entered into after initial application. Now, this relief is optional. A lessee is not required to apply it. The alternative is that a lessee would need to apply the IFRS 16 definition of a lease requirements to all of its contracts to determine whether they contain a lease. Those contracts that do contain a lease would then be transitioned to IFRS 16.
So the question then is, if a lessee does this reassessment, are there likely to be many differences compared to IAS 17? So are there likely to be many contracts for which the lease versus service conclusion is different, applying IFRS 16 as compared to IAS 17?
Well, the short answer to that one is no, there aren't. We'll talk about the definition of a lease in detail in a future webcast. However, to summarise briefly, whilst IFRS 16 contains more detailed requirements on the definition of a lease, the practical outcomes of applying those requirements are expected to give the same result as applying IAS 17 in the vast majority of cases. In fact, in all of its research, the IASB identified no contracts in which an IAS 17 service would be an IFRS 16 lease. In terms of the opposite, one particular scenario was identified in which an IAS 17 lease could become an IFRS 16 service. That example relates to a lessee taking all of the output of an asset but not having any decision-making rights over the use of that asset. In that scenario, whether there's a change in outcomes compared to today would depend on pricing. We understand that the scenario giving rise to a change in outcomes is rare in practice, and in all but this case, practical outcomes are expected to be the same. Ultimately, therefore, the decision that a lessee faces here is whether the costs of reassessing all of its contracts are worth the benefits of identifying any potential differences between IFRS 16 and IAS 17 assessments on the definition of a lease. For most lessees, the outcomes of reassessing or not reassessing are likely to be the same. So there is potentially significant cost relief here, with likely very little, if any, consequence for reported information.
So next, we'll talk about the other decision to be made that will affect the population of contracts on transition. This one applies only to lessees and is a decision about whether to use the recognition exemptions in IFRS 16. These exemptions relate firstly to short-term leases of less than 12 months duration, and secondly to leases for which the underlying asset is of low value. In a future webcast, we'll be talking about these exemptions in more detail, but essentially for these leases, a lessee has the option of accounting for them similarly to today's operating leases. Now, these exemptions are available on an ongoing basis. They don't relate only to the transition year, and therefore the decision about whether to use them needs to include consideration of whether a lessee wants to apply these exemptions on an ongoing basis, rather than focusing only on the effect of the exemptions in the first year of applying IFRS 16. Having said that, however, the most significant benefit arising from using either of these exemptions in terms of reducing costs is likely to arise when first implementing IFRS 16. And therefore, it is important to consider whether to use the exemptions in the context of transition, and also to consider that early in the transition process. So the main consideration in deciding whether to use these exemptions is, of course, the potential population of contracts that might be captured. The real benefit of using the exemptions is that for lessees with high volumes of these leases, applying one or both of the exemptions could substantially reduce the population of contracts for which assets and liabilities need to be recognised when IFRS 16 is applied. So for those lessees, using the exemptions might provide them with significant cost relief.
Moving on then to the second step on the overview slide, which is deciding which of two transition methods to use. We mentioned earlier that the first option is to perform a full retrospective approach in accordance with IAS 8. That effectively means preparing a set of financial statements in the transition year as if IFRS 16 had always applied. This approach would involve restating comparative information and, in accordance with IAS 8, would require some disclosure about all line items affected by the transition to IFRS 16. This is, of course, the default transition approach for a new IFRS standard. However, because we received a lot of feedback about how costly this would be for lessees, IFRS 16 also permits an alternative option with a number of substantial cost reliefs available. This is referred to as the cumulative catch-up transition approach. The first big relief under the cumulative catch-up approach is that a lessee applying this alternative does not restate its comparative information. Instead, it calculates the net effect of applying IFRS 16 on the first day of the first accounting period in which the new standard is applied, and recognises that as an adjustment through retained earnings or other relevant part of equity.
So to clarify, if a lessee applies IFRS 16 for the first time on the 1st of January 2019, it recognises assets and liabilities on that date, applying the IFRS 16 transition requirements, and any difference will be adjusted against retained earnings on that date. So the lessee doesn't restate any of its comparative information? That must affect comparability in the first year?
Yes, it does. A lessee applying the cumulative catch-up approach will be making some compromises in terms of year-on-year comparability in the first year, because the current and prior year financial statements will effectively be prepared on different bases. However, this is partly addressed by the fact that IFRS 16 has some specific transition disclosure requirements to aid comparability in the first year of application. These disclosures are based on the fact that a user would generally expect the lease liabilities recognised on the first day of IFRS 16 application to be similar to the result of discounting operating lease commitments that were disclosed in the previous period, plus any finance lease liabilities. A lessee applying the cumulative catch-up method is essentially required to disclose explanatory information if there's any substantial difference here.
So even with the transition disclosures in IFRS 16, it's going to be the case that the information reported by applying the cumulative catch-up approach will not be of the same quality as that resulting from a full retrospective approach. With that in mind, I think at this point it's worth going into a bit more detail about the information we've had from lessees about why a full retrospective approach is so costly, and how the cumulative catch-up approach provides practical relief for the most significant costs. In assessing the costs and benefits, it's going to be important for lessees to think about the extent to which the cumulative catch-up approach will give them real cost savings, and whether those cost savings are worth it. Could you perhaps talk through some of the bigger practical implications of choosing the full retrospective approach and the cumulative catch-up approach?
Yes, of course. So first, I'll talk about the full retrospective or IAS 8 approach. This slide summarises at a high level what a lessee will have to do to apply that approach when transitioning to the new Leases standard. The slide demonstrates this for an entity with a 31st of December year end that isn't early adopting. Such an entity would transition to IFRS 16 on the 1st of January 2019. Its annual report, prepared the year before, for 31st of December 2018, would apply IAS 17, so that annual report would effectively show a balance sheet that does not include operating leases and a P&L with a straight line rent expense. Then the entity gets to its 2019 annual report. The 2019 financial statements would be prepared on an IFRS 16 basis, so with leases on the balance sheet and interest and depreciation in the P&L. However, in its 2019 annual report, this lessee also has to restate its comparative figures. That means that, in reality, it needs to transition its accounts to IFRS 16, i.e. get all of its leases onto the balance sheet from the 1st of January 2018. The actual transitioning itself will be essentially the same process whichever date it is performed on. But for a lessee applying the full retrospective approach, in order to prepare both its current year figures for the 2018 annual report and comparative figures for the 2019 annual report, it is going to need to run its 2018 financial statements on two different bases. One with operating leases effectively excluded from the balance sheet for IAS 17 reporting, and one with them included for IFRS 16 reporting. In practical terms then, this lessee may need to run two parallel accounting systems throughout 2018, something we've been consistently told by preparers will be costly to achieve. One other thing to mention here is the disclosure requirement in IAS 8 for a line-by-line comparison of the old and new financial statements when a new standard is adopted. This is another thing that lessees were concerned would be very costly. This disclosure needs to be provided for both current and comparative figures to the extent that that's practical in the first year, i.e. it is provided at both 31st of December 2018 and 31st of December 2019. So IAS 17 data will also need to be estimated for the 2019 year when IFRS 16 is applied.
So comparing that then to the cumulative catch-up approach, in practical terms, this method is much more straightforward?
That's right. And in short, that's because this approach can be applied without the need to run parallel accounting systems at any point. That's for two reasons. First, comparatives don't need to be restated. That means for the same December year-end lessee we just talked about, the accounting system can do a straight switch from IAS 17 to IFRS 16 on the 1st of January 2019. Before that date, all reporting is on an IAS 17 basis. After it, all reporting is on an IFRS 16 basis. The entity doesn't need to report both IAS 17 and IFRS 16 figures for either period. Second, disclosure. I mentioned before that the IFRS 16 cumulative catch-up approach contains some special transition disclosures that replace the line-by-line comparison required by IAS 8. The IFRS 16 disclosure is, in essence, a comparison between discounting operating lease commitments disclosed at 31st of December 2018 and the amount of lease liabilities capitalised on 1st of January 2019. Whilst this does require a piece of data capture immediately after transitioning leases over to IFRS 16, that data capture is at a single point in time, i.e. the point of changeover. There are no requirements to disclose any IAS 17 based figures after that date. Having said all that, I should reiterate that the IAS 8 approach does give a better quality of information in the transition year, and that's why some lessees may prefer to take that approach anyway. The final thing to point out before moving on is that a lessee applying the cumulative catch-up method has a number of other optional reliefs that it can take. The rest of this webcast refers only to a lessee applying the cumulative catch-up approach, and on the next few slides we'll run through what those other available reliefs are.
So the first optional relief that a lessee applying the cumulative catch-up approach will need to think about is essentially an extension of the short-term lease exemption that I talked about earlier. The board noted that when comparatives are not restated on transition, any lease whose lease term ends within the first 12 months of applying IFRS 16 is in principle very similar to a short-term lease, regardless of when that lease commenced. So for a lessee that first applies IFRS 16 on 1st of January 2019, that would be any lease with a lease term ending during 2019. Therefore, a lessee applying the cumulative catch-up approach has the option of treating these leases in the same way as any other short-term lease on transition. In other words, a lessee can choose not to recognise assets and liabilities for these leases and simply account for them similarly to IAS 17 operating leases. So effectively, these leases won't need to be transitioned to IFRS 16. Using this relief could therefore provide some pretty significant cost savings for lessees on transition to IFRS 16.
Doing that raises a couple of questions though. Isn't there a comparability issue because the short-term lease portfolio in the first year will be bigger than normal? Also, a lessee needs to think about what would happen if one of these leases was to be extended at the end of its term.
Of course, that's right. So in the first point, recomparability, there is a potential issue here because for the most part, an individual lessee's portfolio of short-term leases would be expected to be broadly consistent year on year. So the general IFRS 16 disclosure requirement for short-term lease expense gives investors a good idea of the level of assets and liabilities that this exemption covers. If this extra transition relief is taken, the amount of short-term leases in the first year may not be representative of the ongoing population of short-term leases. However, it is worth noting that IFRS 16 also requires disclosure in the event that the short-term lease expense in a given period is not representative of the ongoing portfolio of short-term leases. This disclosure will be applicable in the first year as it is in any other year. So if short-term leases increase materially by way of using this transition relief, a lessee will be required to make that clear in its financial statements. Now, on the question of extensions, if a lease for which no asset or liability has been recognised is subsequently extended, the extension is treated as a new lease. So assets and liabilities would then be recognised when the lease is extended in the same way that they are for any other new lease. So moving on then, a lessee now has the complete population of contracts for transition and now needs to measure the lease liability. At a high level, and before considering any available transition relief, a lessee essentially does this by applying the general IFRS 16 requirements for measuring lease liabilities. So it takes the future lease payments and discounts them at an appropriate rate. In terms of establishing exactly what those lease payments are and how to arrive at the right discount rate, the detail on these measurement issues will be the topic of an upcoming webcast focused solely on measurement, and that one will be coming in April, so I won't go into detail here. But to clarify, on transition, measuring future lease payments means just that. For leases ongoing at the date of transition, a lessee won't need any backward-looking information to arrive at the lease liability. It will look at the payments for the remainder of the lease term and discount those payments. So now, in terms of transition relief available when measuring the lease liability, there are a couple of things to mention, and both of these are optional. So first, a lessee is permitted to apply a single discount rate when transitioning a group of leases with similar characteristics. And by that we mean things like similar remaining lease term, similar underlying assets, and similar economic environments. Second, IFRS 16 permits the use of hindsight on transition when looking at things like extension options. I mentioned that we'll go into detail on measurement in a later webcast. However, just to give a simple example, say a lessee entered into a 10-year lease in 2014 with a termination option during 2019. Now, at the time of entering into the lease, the lessee wasn't reasonably certain to terminate, so it treated the lease as a 10-year lease. Now, by the time it transitions to IFRS 16 on the 1st of January 2019, something has changed, and the lessee is now reasonably certain that it will terminate the lease. So on transition, the lessee does not have to stick with the judgment it made back in 2014. Instead, it can use hindsight and factor the termination in when measuring the lease liability at the 1st of January 2019. This approach has two advantages. Firstly, that reporting will be based on the most up-to-date information, and secondly, that a lessee will not need to perform a historical sort of what-if assessment that could be difficult to do. So if we move on to the final step in the transition process, measuring the right of use asset. Catherine, could you summarise?
Of course. So the default approach here is to apply the general IFRS 16 requirements, effectively measuring the right of use asset as if IFRS 16 had always applied. However, unlike for the lease liability, measuring the right of use asset properly, so to speak, does require some backward-looking information. That's because, as the left-hand side of this slide shows, a lessee would first need to establish what the right of use asset would have been at lease commencement, and then work out what the accumulated depreciation at transition would be. Getting to these amounts requires a lessee to have information about lease payments since the beginning of the lease.
Now, gathering that backward-looking information must involve some cost for lessees?
Yes, it does. The feedback we've had is that getting to that information for all leases might be challenging for many lessees. Having said that though, any conceivable alternative to measuring right of use assets in this way would mean an approximation, i.e. the number wouldn't be totally accurate on transition. Because of that, there are definitely circumstances where lessees will want to measure the right of use asset properly, even with the requirement to get some backward-looking information. I'm talking here, of course, about individually significant leases, i.e. the properties, the aeroplanes and the oil rigs, for example. In these cases, measuring right of use assets on transition using any kind of approximation means not only will the transition balance sheet be a little out, but also that depreciation charges in the P&L for the rest of the life of the lease won't be quite right either. For material leases, it's generally going to be worth some extra information capture in the first year in order to make sure that the future P&L charges are the right ones.
So I think many will agree that that's true for the really significant leases. However, we've talked already about lessees that have a high volume of low-value leases. For them, it's hard to imagine that the cost of gathering backward-looking information on transition would be worth it.
That's right, certainly based on the feedback we've had. For those high-volume, low-value leases, we expect the financial reporting effect of an approximation to be insignificant. For that reason, IFRS 16 offers a choice here. Instead of measuring the right of use asset properly, so to speak, a lessee can, on the date of transition, set right of use assets equal to lease liability. This approach is clearly less costly, but the consequences are that the right of use asset on transition will be measured a bit too high. Subsequently then, Annual depreciation charges for the remainder of the lease will also be a bit too high, and the longer the lease term and the higher the discount rates, the more significant this effect will be. So that means, where this choice is taken, operating costs for the remainder of the lease will be slightly higher than if the right of use asset is measured properly. Therefore, a lessee is really only likely to want to do this for those leases where the reporting difference is insignificant and the costs of measuring properly are high. In other words, the high volume, low value leases.
So to really be useful, this relief needs to be on a lease by lease basis, rather than having to apply the same approach to all of its right of use assets. To clarify, that's a difference as compared to all of the other reliefs we've discussed today?
Yes, it is. This choice of right of use asset measurement is on a lease by lease basis. That means a lessee can apply the more costly and more accurate approach to its significant or material leases and the more approximate approach to the immaterial ones. For the avoidance of doubt, there are no requirements in the standard on the basis of that choice, i.e. a lessee applying the cumulative catch-up approach is free to choose which leases it applies which approach to. However, the P&L consequences do mean that it will generally be in a lessee's best interests to apply the retrospective measurement to any leases that have a significant effect on its financial reporting. That's going to be a key factor in decision making here. Ultimately, the choice permitted in IFRS 16 is enabling a lessee to judge, in its own individual circumstances, what the material leases are and balance the cost-benefit assessment accordingly. This slide covers two further optional reliefs that a lessee can apply to its right of use asset measurements. First, the left-hand side of the slide refers to onerous leases. This relief really relates to a lessee considering any potential impairment on right of use assets on the date of transition. Strictly, a lessee needs to consider whether its right of use assets are impaired once they have been brought onto the balance sheet. However, IFRS 16 offers a simplified way to do this. This is based on the fact that if a newly recognised right of use asset is impaired at the point of transition, then the former IAS 17 operating lease that the new right of use asset relates to would have been an onerous lease in accordance with IAS 37. IFRS 16 therefore permits a lessee to adjust the right of use asset on transition by the amount of any previously recognised onerous lease provisions. A lessee can choose to do this instead of performing an impairment review.
And the reporting outcome of doing that instead of performing an impairment review is presumably quite similar?
Yes, it is. In terms of the potential impact on financial reporting, applying this relief is not expected to be significant. That's because any onerous lease provision measured in accordance with IAS 37 at the end of the previous period would be expected to be similar to the amount of any impairment required on initial recognition of the right of use assets on the first day of applying IFRS 16. Both of these measurements ultimately represent the extent to which a lease is not going to realise its value for the lessee. The final transition relief permitted by IFRS 16, shown on the right-hand side of this slide, relates to initial direct costs. These are incremental costs of obtaining a lease that an entity would not incur if the lease wasn't obtained. So an example would be something like payments to a previous tenant to vacate a leased property. These kinds of costs are normally included in the initial measurement of a right of use asset. However, on transition, a lessee is not required to factor these costs into its right of use asset measurement. Whilst this is not expected to have a significant impact on reporting, it will provide cost relief to the lessee. That's mainly because it won't be necessary to identify these costs. something which is difficult on transition when any initial direct costs associated with a lease might have been incurred a long time ago.
So we've now talked through all of a lessee's transition steps in some detail. So firstly, identifying the population for transition. Secondly, choosing the transition approach. Thirdly, considering the 12-month exemption. Fourthly, measuring the lease liability. And finally, measuring the right of use asset. This final slide notes a couple of links to further information that can be found on our website. The second link, which is to the Leases implementation page, summarises all of the work the board is doing to support implementation. Within that, there's some information about the rest of this webcast series. We've mentioned other upcoming webcasts during this presentation, and the full list can be found by following this link. We thank you for listening to our webcast and hope that it was helpful.